On March 24th, a report released by the International Institute of Finance shows foreign capital has been leaving China on an unprecedented scale since the war in Ukraine. The main reason is that overseas investors are concerned that US and EU sanctions against Russia could somehow spill over to China. At almost the same time, on March 23rd, the US Department of Commerce announced that it has renewed tariff exemptions on more than 300 types of Chinese product imports. Why did the US do this? It's likely because the war between Russia and Ukraine is at a standstill, and the balance of power and tension between the US, China, and Russia has been broken. The US and China have now started to compromise to some extent due to the war. So, what do these changes mean for foreign investors? Let's first look at the tariff exemptions for Chinese goods. Former President Donald Trump launched a trade war with China in 2018, imposing punitive tariffs on $370 billion worth of Chinese imports. Subsequently, in an effort to cushion the resulting impact on some industries, the Trump administration exempted 2,200 products from tariffs, of which 549 products exemptions were granted for a one-year extension. Most of these exemptions expired at the end of 2020, so many importers have been pressuring the Biden administration. The Wall Street Journal reported that the Office of the U.S. Trade Representative received more than 2,000 applications from the business community, mostly for tariff exemptions, but some companies want to keep the tariffs in place to deal with the onslaught of low-cost Chinese imports. On March 23rd, the Biden administration decided to reinstate tariff exemptions for 352 Chinese imports after the expiration of tariff exemptions. The effective date will be retroactive to last October 12, 2021, and will take effect throughout 2022. The exempted items include specific types of bicycle parts, motors, machinery, chemicals, seafood, and duffel bags, most of which are low-end or low to mid-range products. The Office of the U.S. Trade Representative explained that the considerations for the tariff exemptions included factors such as whether the products in question could be obtained outside of China, whether they could be produced domestically in the U.S., and what impact the supply chain shift in question would have on global procurement. The U.S. government noted that in a state of pandemic and war in the world, it would take time to adjust the industrial chain. The tariffs on Chinese goods would cause economic damage to the U.S. because it could worsen supply problems and push up consumer pricing. Currently, the U.S. is facing record inflation. The reaction to this move from the U.S. public has been mixed.
Seems like a good idea. Every time there's been a trade war, everyone jacks their prices up, so it didn't seem to work so well historically. Why keep it up?
It is about businessmen and consumers who have been asking for the tariffs to be reduced. To get to the inflation point, our Treasury Secretary has said that reducing tariffs would help mitigate inflation, but in this case, we're talking about 350 product lines out of tens of thousands and tariffs on $350 billion worth of goods. So I don't think it's that significant in that sense.
Without a doubt, war and the sanctions that come with it have obvious consequences. Driven primarily by the cost of gasoline, food, and housing, the U.S. Consumer Price Index, CPI, rose 7.9% in February, a 40-year high. Federal Reserve Chairman Jerome Powell said on March 21st that the Fed must act quickly to curb excessive inflation. He also warned that the Russia-Ukraine war and Western sanctions against Russia could further exacerbate the problem of supply chain disruptions and lead to a general spike in commodity prices, such as energy. Recently, gasoline prices in the U.S. have soared to record highs, yet the Biden administration has yet to find a good way to curb spiraling gas prices as the summer travel rush approaches. White House officials have publicly stated that all options are under consideration, including gasoline tax relief and a deal with Iran and Venezuela to lift sanctions on their oil exports. However, these alternatives are more or less troublesome, and there is no way to significantly reduce gasoline prices. Reuters reported on March 22nd that a poll conducted in cooperation with Ipsos showed that President Joe Biden's approval rating fell to a new low of 40%, down 3 percentage points from the previous week. Respondents cited the economy as the top concern, followed by war and overseas conflicts. China is an important equalizing force in the chain effect triggered by Russia's war with Ukraine, and it has been significant in the supply chain since the globalization of the economy. There are some indications that Russia is being pushed towards Beijing in a general environment of international isolation. According to Refinitiv Icon Rail data, Russian companies plan to supply about 72,000 tons of LPG, or liquefied petroleum gas, to China in March, while in February the figure was 24,000 tons. That is, under the fire of the Russian-Ukrainian war, China's purchases of Russian LPG increased twofold compared to February.
Again, we are watching very closely to the extent to which the PRC or any country in the world provides support, material, economic, financial, rhetorical, otherwise, to this war of choice that President Putin is waging against the government of Ukraine, against the state of Ukraine, against the people of Ukraine. And we have been very clear, both privately with Beijing, publicly with Beijing, that there would be consequences for any such support.
Against this backdrop, on the evening of March 18th, Biden and Chinese Chairman Xi Jinping held a video call. The U.S. media reported that Biden warned Xi during the meeting that China would face consequences if it provided material support to Russia. Immediately after the meeting, China sent 10 million RMB in humanitarian aid to Ukraine. This could be seen as a concessionary gesture by the Chinese Communist Party, or CCP. The Chinese government has decided to provide another batch of humanitarian aid worth 10 million yuan to Ukraine. This is China's newly added humanitarian aid to Ukraine based on the development of the situation and actual needs. China will continue to play a constructive role in promoting the de-escalation of the situation in Ukraine and is willing to make its own efforts to overcome the humanitarian crisis. There is very little public information available on what else Biden and Xi talked about. Has the CCP made any demands on the US in response? Depending on how clever the CCP is in this regard, it is likely that it would have taken the opportunity to make a deal.
China has noticed that on March 23rd, the Office of the United States Trade Representative announced that it would reinstate 352 product exclusions from tariffs on Chinese imports, which is conducive to the normal trade of related products. The Chinese side has always believed that the unilateral tariff increase by the U.S. side is not good for China, the United States, and the rest of the world. In the current situation, where inflation continues to rise and the global economic recovery faces challenges, we hope the U.S. side will proceed from the fundamental interests of consumers and producers in China and the United States, cancel all additional tariffs on Chinese products as soon as possible, and push bilateral economic and trade relations back to the normal track as soon as possible.
Now, let's turn our attention to China. A report from the International Finance Association on March 24th shows that there has been a massive outflow of capital from the stock and bond markets in mainland China. Foreign investors have sold $9.5 billion worth of stocks in China this month. Another Bloomberg report has revealed that foreign investors have reduced their holdings of Chinese state bonds by a record size in February. Such a trend has to do with the war between Russia and Ukraine. It is a wake-up call for foreign investors who are reassessing geopolitical risks after Russia has been financially ousted. Previously, the Securities and Exchange Commission, or SEC, has disclosed that 5 Chinese companies are at risk of delisting for failing to comply with audit requirements. It has sparked investor fears as well. The Wall Street Journal reported on March 16th that the SEC launched a full investigation into the Big Four accounting firms, including Deloitte, Ernst & Young, KPMG, and PricewaterhouseCoopers. According to people familiar with the matter, the SEC is investigating whether the consulting and other non-audit services they offer have undermined their ability to conduct independent reviews of the financial condition of public companies. On March 23rd, the U.S. announced to renew the tariff exemptions on some Chinese products. On the same day, the SEC added the 6th company to its pre-delisting list, Weibo Corp., the equivalent of Twitter in China. J.P. Morgan said in a March 14th report that due to rising geopolitical and macro risks, many global investors fled the China internet sector, leading to significant fund outflows. It has also downgraded 28 Chinese stocks listed in the US and Hong Kong, including Tencent, Alibaba, and Jingdong, citing international investors beginning to digest China's geopolitical risks and increasing concerns about regulatory risk in China. The sell-off of Chinese stocks by foreign investors has brought down the Hong Kong stock market and the A-share market in mainland China, creating a sense of panic. Around March 12th, Bloomberg reported that the Nasdaq Golden Dragon China Index fell 72% from its peak, equivalent to the stock market's decline during the 2008 financial crisis. Alibaba alone has lost about $522 billion in value, the largest loss of shareholder wealth worldwide. The top 18 US listed Chinese stocks, including Didi, have seen their share prices fall by 90%. The massive trend of foreign investment leaving has apparently alarmed the CCP as well, and Beijing is prepared to make some compromise. Reuters reported on March 22nd that Chinese regulators were considering, in some cases, allowing US regulators to inspect the audit working papers of some Chinese companies, the ones that don't collect sensitive data. As a result, China's Securities Regulatory Commission has asked some US-listed companies, including Alibaba, Baidu, and Jingdong, to prepare audit documents for fiscal 2021 in anticipation of additional disclosure requirements from US regulators. If these companies are unsure about anything throughout the process, it would be wise to seek the advice of state regulators. It appears that Beijing is currently working to make sure that Chinese companies continue to stay listed in New York. Prior to this, the CCP had imposed stern industry regulatory policies which resulted in an overall setback for the earnings of Chinese tech giants. Chinese media have reported that Alibaba and Tencent Holdings are preparing to cut tens of thousands of jobs in 2022. Europe has been relatively friendly to Beijing, but now there are signs of a gradual hardening stance by Europe as well. While the EU has no interest in fully decoupling the European and Chinese economies, the Russia-Ukraine crisis has prompted it to think deeply about how to reduce the risk of China weaponizing the economic ties. There are more indications that European countries may apply tougher scrutiny to deals with China. Reuters reported that Italy, on March 10th, scrapped the transaction of selling a military drone company to a Chinese investor. The Wall Street Journal reported on March 16th that China received a setback in its sale of submarines to Thailand. The contract specified that the submarines would be equipped with German diesel engines, but Germany refused to sell the engines because it feared they would be used in CCP military or defense industry projects. The $410 million deal was supposed to showcase the CCP's impressive defense exports, but it turned awkward due to the lack of German engines. Thus, recently, Chinese regulators have been trying to send signals to the public to stabilize the capital market. On March 16th, at a meeting of the Financial Committee of the State Council held in China, Chinese Vice Premier Li He, director of the Financial Committee, mentioned that Chinese and U.S. regulators are working to form a concrete cooperation plan and said that the government will continue to support all kinds of enterprises to go public outside of China. On that day, Hong Kong stocks jumped 9%, posting their best day since 2008. On the other hand, China's high-tech giants such as Ali, Tencent, and Xiaomi are now buying back shares in a big way to save their share prices. On March 22nd, Alibaba Group announced that it would expand the size of its share buyback program, which was launched 2 years ago, from $15 billion to $25 billion, the largest buyback in the history of Chinese stocks. In the evening of the same day, Xiaomi also announced that it would buy back shares at a maximum total of HK 10 billion at an irregular interval. In addition, Tencent has also repurchased a total of over HK 2 billion worth of shares several times this year. According to the statistics of Royal Flush, a stock trading analysis app, more than 100 companies have repurchased shares in the Hong Kong stock market in 2022, with a total amount of HK 8.52 billion, which is 3 times more than the same period in 2021. In general, the intention of a company buying back its shares is to assure the capital market. Buybacks can push up share prices by reducing the number of shares available in the market, as well as improving earnings per share. Repurchases also demonstrate that management is confident in the company's outlook and financial position. It can, in turn, boost investor confidence. Whether buybacks can really boost the confidence of overseas investors remains to be seen. After all, the ruling party in China has a peculiar system and mindset. Over the long term, whether the CCP is willing to give up interfering with business practices and to improve the overall regulatory environment is directly related to whether it's able to keep its power. Having been immersed in more than 70 years of party culture, Chinese companies suffer from widespread financial fraud. Moreover, China's current economic growth rate has slowed significantly. The complicating factor of the Russia-Ukraine war has added to the continued tensions between China and the US. With all of these factors at work, an overseas investor needs to be more cautious and rethink if holding Chinese stocks is a good investment.